A $600 billion package of mortgage-backed securities is about to be sold, but the underlying loans are defaulting at an unprecedented rate. In the conference room of Bear Stearns, analysts huddle over their laptops, reviewing alarming data. Mortgage defaults have surged to 8.4% in some regions. Traders focus solely on potential profits from the deal. One analyst stares at the screen, calculating risk but hesitating to speak. The clock ticks down to the sale, pressure building. Outside, the housing market collapses. Home prices plummet 30% in the last year. Firm leadership insists on proceeding with the sale, convinced of strong demand for these securities. Analysts scramble to adjust their models, but projections show a stark reality. Expected returns are rapidly diminishing. A senior trader bursts into the room, announcing a secured $200 million buyer for part of the package. Analysts exchange glances, aware the buyer remains oblivious to rising defaults. The trader pushes for more sales, urging the team to offload as much as possible. They execute trades, moving quickly as the market buzzes with activity. As the day progresses, news breaks that major lender Countrywide Financial has reported significant losses due to rising defaults. Bear Stearns stock dips 5%, but traders remain optimistic, convinced the market will stabilize. They push ahead, selling off another $150 million of the securities. The following week, the situation worsens. Lehman Brothers announces a $3 billion write-down on mortgage-related investments. Panic ripples through financial markets. Bear Stearns analysts scramble to reassess positions, but urgency to execute trades drowns out their concerns. A week later, management holds an emergency meeting. The default rate climbs to 10%, and investors question the stability of mortgage-backed securities. Analysts present revised risk assessments showing plummeting values. Management dismisses the findings, insisting the market will recover. In a bid to stabilize their position, the firm decides to issue a new round of securities, offering a higher yield to attract fresh capital. The response is tepid. Analysts watch as skepticism grips the market. Yield spreads widen, indicating growing distrust in the securities. As the next month unfolds, the financial landscape shifts dramatically. A report reveals subprime mortgage delinquencies have reached 15%. Analysts project Bear Stearns mortgage-backed assets could lose up to 40% of their value. They prepare to present findings to management again, the mood tense. During a critical meeting, analysts outline the potential for catastrophic losses if the firm does not act swiftly. Management remains unconvinced, arguing the firm's reputation is at stake and insisting on maintaining market confidence. Analysts suggest reducing exposure, but management holds firm. The following week, news breaks that the government is considering a bailout for struggling financial institutions. Bear Stearns stock plummets another 20% as investors flee. Analysts receive frantic calls from investors demanding answers. In a last-ditch effort, Bear Stearns seeks a line of credit, approaching JP Chase for a $30 billion lifeline. JP Morgan's analysts conduct due diligence, uncovering Bear Stearns' exposure to toxic assets. Hesitation sets in, sensing the risk of association with the faltering firm. The next day, panic erupts. The stock price tumbles to $2 per share, down from $170 just months earlier. Analysts gather in the conference room, watching news of Bear Stearns' potential collapse spread across financial networks. They update models, projecting over $2 billion in total losses if the firm cannot secure the credit line. With the clock ticking down, JP Morgan finally agrees to a deal, but with stringent terms. Bear Stearns must agree to a fire sale of its assets, liquidating holdings at a fraction of their value. Analysts watch as hundreds of millions in securities are sold off, prices plunging further in reaction to the news. By the end of the week, the firm is effectively insolvent. Final numbers reveal a staggering $3.2 billion loss for Bear Stearns, erasing years of profits and leaving the firm in disarray. Analysts file out of the conference room, their positions in the market wiped out. The aftermath is swift. The financial crisis deepens, triggering a chain reaction across Wall Street. Bear Stearns is acquired by JP Chase for just $236 million, a fraction of its former glory. Analysts reflect on the collapse of a once mighty institution and their role in its downfall. Mortgage-backed securities that once promised high returns are now worthless. Bear Stearns ends with just $1 billion in remaining capital. The firm's decision to ignore rising defaults while pursuing profit led to its demise. A prudent reduction in exposure could have altered the outcome.